Rob's child. Nothing I say is investment advice, and I have no intention to replace the contents of this book, but to open it for discussion. Chapter 34. The relation of depreciation and similar charges to earning power. I found this chapter to be somewhat useful. He basically goes into a lot of detail dealing with depreciation and continues to basically complain about accounting methods and how they can trick people. In Graham's ideal world, all accountants do their accounting exactly the same way. That's kind of the biggest takeaway that I get out of this. And he has like a specific way that he thinks that it should be done in order to not trick investors. I went into some of his explanations of how companies manipulate their earning power throughout this chapter, and the truth is some of his criticisms of accounting methods are valid accounting methods, but I can also understand the utility of having all accountants do their accounting in the same way in order to make it easier for investors. I mean, at the end of the day, it's true. What is the purpose of these documents that are sent to shareholders? It's to give the shareholders an idea as to what's going on in the company. And if it's not clear cut and truthful, then it just makes investors' lives more difficult and complicated unnecessarily and doesn't do anybody any good. So let's go through the main points. We start with going through the 4 types of depreciation-like charges. And I quote, there's depreciation and obsolescence, which is replacements, renewals, or retirements. Number 2, depletion or exhaustion. So like an oil well or a mine that has limited resources to be able to extract with the equipment that's been built. Amortization of leaseholds / leasehold improvements, licenses, etc. We'll go into some details with that. I wrote notes throughout this whole chapter. And the 4th one, amortization of patents, the least relevant one in Graham's mind. So in a nutshell, we begin the point that depreciation assets should be charged across the lifespan of the asset. And when you don't do that, it can create problems. It can make it, if you don't charge enough to earnings, then what happens is all of a sudden this thing that you paid for is either completely worn out or it doesn't work anymore. It doesn't, that doesn't have much any earning power left in it, and it hasn't been charged against the earnings, and so then you have a useless supposed asset. And then in order to replace that, in order to roll that over into, maybe another oil well, something like that, you need more investment on top of that. And so, you're adding on more debt. And if that's not getting charged properly, then it makes earnings look like they are higher than they really are. And again, that's the general idea of this whole chapter, really. So, but point by point, again, he says the main issues specifically are that the total cost can be adjusted of the asset. He lists that as an issue because when you have something and the value of it in the marketplace changes, then that charge to earnings has to reflect that. And that can be if the property increases value or decreases value. And it matters if it's been increased in value, if that value increase is actually usable, if it's sellable, if otherwise, if it's not a useful asset and supposedly has a certain price to it, it's like, that's pointless. But he says that companies often fail to charge this properly in the income account. And then the third issue is that accounting doesn't explain properly what's happening to an investing standpoint. Again, these documents that are put out to the investors should serve the investors, and that's kind of like I said before, and he repeats many of these points, it seems, ad infinitum. And then he says in this part that point he's making basically is the premise of this chapter and the next chapter 35. Then we move on to the subtitle Depreciation Base. So your base case is the purpose of charging depreciation is to typically anticipate the replacement of the asset. Again, if you build a mine, which takes a lot of money to build, and the mine is a silver mine and it runs out of silver, there's no more silver. Well, all of a sudden a mine on top of a silver mine on top of a silver mine that has no silver in it is useless. In fact, if anything, it's in order to destroy it or to get rid of it, it could even cost you more to get rid of it. So that depreciation charge is very important. He mentions that this, again, mines and oil are different. He talks about this later in the chapter, but in this part of the chapter, he says how they're virtually never followed, the depreciation of assets, so that they're able to be replaced. And he brings up an example of the Great Depression asset value loss, lowering the depreciation charge. And then he says that this is okay because if replacing it costs less, then if you're charging less. So if you paid like $1 million for a mine, and let's not call it a mine. Let's call it a building. All right, and the value of the building goes down really, really far. Well, what happens is, in order to replace that building in that time period during the Great Depression, a lot of, let's say buildings were cheap. Well, then to replace, we're talking about replacement costs there and how that should be included with the basis of calculating depreciation. Then he goes on talking about how companies will cheat on this in order to make earnings look stronger. And they'll also cheat by marking up assets without raising the depreciation charges. So I bought a building, hey, it's worth more now because real estate is up, but then they won't charge more to the income account in order to account for the fact that if and when that needs replacing, it costs more now, and so that depreciation charge should be more. And oftentimes companies do not do this. Side note right here, I still don't know how much of this is still relevant. I'm sure that a good amount of regulations since this edition of this book was written have changed over time. And I do plan on doing sort of a update, going through the updates to this book since it was written in a separate series eventually, but that's a little further down the line. But to get back to the points, he shows an example of charging a markup to the capital surplus of depreciation instead of to the income account. And then a second similar example. Then we move on to another subtitle, rate of depreciation standard and non-standard. Now I quote from the book. He says the vast majority of industrial companies charge depreciation appropriately. So he's happy with industrials because industrials are straightforward, apparently, about their depreciation. And if you have any doubts, he says you can check the prospectus or registration statements to verify, to make sure that the accountants aren't trying to be tricky. Then we go on to talk about examples of standard depreciation being a percentage rate per year. He has a chart of standard depreciation, what's considered to be appropriate standard depreciation charges. One of the ones I was surprised by, you can see in the book, is the 25% charge to automobiles and trucks. And, you know, if you're a car owner yourself, you might be able to understand that. I mean, especially back then, I think that cars I know cars in that period would have to have parts replaced more often, and to the point where it's 25% a year. So, you know, you expect your car to last 4 years without any replacement of parts or fixing things, but that 25% every year on the value of, but it's still very high. That's very high, 25% depreciation. I found that very interesting. It's probably a little less today. But again, and then maybe insurance on the vehicles is included in that depreciation charge. It being the fact that it has so much liability for accidents as well. Then we go through examples of companies following and not following standard depreciation charges. He mentions problems arising especially in mergers. And then we have a section on what he calls concealed depreciation. And he shows the example of American Can Company was apparently concealing depreciation. And he said it could have been detected because similar smaller companies had equal depreciation charges that were smaller or something like that. He said you should have been able to detect that if you were a savvy investor, basically. And then he has an example of American Biscuit Company overstating depreciation, causing earnings to look lower for a long time. And, you know, again, like, in a way that's like good for the investor because it's like, surprise, your shares are actually worth a little more, but who knows? Are they trying to manipulate the stock price lower so insiders can buy in more, or, you know, what's going on there? There's a little point in here talking about an update that happened in the laws of accounting, and he says companies used to charge depreciation against earnings but not report the charged amounts. So they would just take it away and not tell you how much they're taking away. And then he says the new law is that they do have to report depreciation charges made to earnings. Then another point, he discusses depletion / amortization of mines and oil wells being having arbitrary tax rules, sort of forcing some companies to exclude their depreciation charges, apparently. And so that just brings up another general point, the fact that some of this accounting is forced by things like taxes, things like regulation, things like what the government says that you have to do or you can't do. And yeah. So Graham approves of this, but then he says, therefore, it's the analyst's responsibility to calculate the depreciation, or at least, try to see what they report. And that's that point. And then we go on to depletion matters more for oil wells than mines. And I think that has, that's more relevant, especially, it's still relevant, I believe, today for oil wells in the U.S. because the sources of oil are smaller, and so it requires more constant reinvestment into new oil wells. While there's, what I understand is there's many oil wells today, especially in the Mideast, that are so large that it's less of an issue than the oil we produce here in America. And Lynn Eldon talks about this, how that constant reinvestment is really needed for oil production in the U.S. specifically. I wanted to include that point. And then, he says, in an oil well, you have to do the depreciation charge based on the barrels produced over the year. And because he says that normally in an oil well, 80% of it is extracted within the first year. And so you can see how it would be more appropriate to have higher depreciation charges in the first year than following years, obviously. And then he talks about how there's not really any need for that because the charge is over a much longer time horizon. Mines, apparently, and I didn't even know this, but it makes sense. Like, think about like Cameco, even with uranium, they're sitting on the same properties forever. Like, they don't have to move and keep building. They just keep digging, and it seems to last forever, a lot of these mines. And of course, some mines, depends on what the mine is, how much is there. And then, that gets more complicated. And then, in the uranium, how deep is it? But we're not getting into that in this. And then we have a little section on writing about how capitalizing write-downs and intangible drilling costs to increase earnings temporarily. He says that this can, and I quote, may arouse some resentment in investors, but when it's done correctly and fairly, it is just good business. Initial costs make sense to spread out over the duration of the assets or charges. And on page 462, the two conclusions on analysis. One is for integrated, which means accepting the depletion against some income, not against appreciation. And then the other one for oil only, which simply is about analyzing oil companies for what the market is paying for developed oil reserves. And that's how you can analyze a company like that. Then we have a section on amortization of leasehold improvements. So even though you're improving the land by building oil wells on the oil, they lose value over time as they're drained. And once all the oil's gone, the oil well there is useless. I guess maybe you can break it, maybe get some parts out of it, get some of the materials back, but the cost is really building the well, and then it becomes useless. And then the last big point that I see in here is discussing book value of patents. He says it's not very helpful for amortization. So patents are obviously, a lot of patents eventually run out. They have a certain timeline before other companies can sort of use it. But I think some patents I think that's more in the medical field, right? They get to produce their medicine for a certain amount of time before generic brands are allowed to basically copy it. And then there are other kinds of patents can, last forever, as long as, and so there's not really a need for trying to figure out amortization of those. But I think today some patents are more relevant for amortization than others. And that's all I have for you today for chapter 34. Hope you enjoyed. Rob's Child.